Hi, Gabriel Josiah here again. All right, in the last class, we looked at the operating profit margin. Right now, we're looking at the earnings before interest, taxes, depreciation, and amortization profit ratio. It's also known as EBITDA Profit Ratio or EBITDA Profit Margin, which is our sixth in the series. Okay, let's quickly look at that without further ado. Let me share my screen and we'll look at that graphically. Okay, the EBITDA profit ratio is also known as EBITDA margin. This profitability ratio measures a company's earnings before interest, before taxes, before depreciation and amortization. It is expressed as a percentage of revenue. Also provides a clear picture of a company's operational profitability by focusing on all earnings and excluding non-operating costs. So the EBITDA ratio indicates how much a company's revenue is converted into operating profit. It excludes the effects of financing, loans, or other borrowings or long-term borrowings like interest and other external obligations like taxes, and non-cash items like depreciation and amortization on your assets, which are tangible and intangible. This metric is commonly used to assess a company's operational efficiency, cash flow generation, and ability to service debts. So the EBITDA is a measure of the core profitability calculated by adding back your interest, your taxes, D&A back to your net income. So this is the formula here. It's the EBITDA divided by your revenue expressed as a percentage. So with this formula, let's continue with our example to describe practically how to calculate this ratio. So still using Sharubutu Nigeria PLC, the example we'll be using for our discussion and our practice. Let's look at how to calculate the EBITDA profit ratio. So back to the question, we look at the earnings, which is our bottom line. We look at the net income, then we add back all the items to arrive at our EBITDA. So how do we do that? Okay, let's start by picking our bottom line, which is our net income or our profit after tax. And go back to the Excel. If you're using your calculator, just follow me as I practice this easily. It's very easy, but it's not simple like I usually and humorously say. It's easy, but it's not simple. Okay, so added back brought forward our profit after tax. So let's go back and add the other items. So we add our expense, our tax expense. Let's add it back to our bottom line. So adding back our tax expense to the bottom line, we have the first item added back. Let's go and deduct our finance income. Our finance income, which is supposed to be here. So let's develop this. Good. So that's a negative figure. Let's go and add back our interest. Let's add back our interest, which is 20 million naira. Okay, so we add it back to our bottom line to have it. So having added our interest, tax, have to add back depreciation and amortization. So let me just pick the two, depreciation and amortization. That will be it for our earnings before interest and taxes. So added back depreciation and amortization to that. So this is our EBITDA. This is our EBITDA. So let's add everything. And we have our EBITDA figure, which is 120 million. So if you go back to the question, you will see it here as our EBITDA. You can see, but it's safer to take all the items and add them back to the bottom line. This is safer to calculate. Okay, so let's look at that and pick our revenue figure. Let's take our revenue figure and express it as a percentage. So our revenue figure includes 1.2 billion naira. So let's take that and add it to our calculation. If you're using a calculator, you know how to add that. So we have our EBITDA as 120, and we have 120 million, and we have 1.2 billion. And that would be our EBITDA divided by our sales or revenue. So this is expressed as a percentage, and that is 10% EBITDA profit margin. So for the year 2020, based on this question, we're able to generate, as at 31st December 2020, a 10% earnings before interest, tax, depreciation, and amortization profit ratio. So this is also known as EBITDA profit margin. So this is positive, and for this first year, it's commendable, shows promising future management could do better in the future. So you can also calculate on your own the 2021 EBITDA and 2022. For the sake of time, we may not be able to calculate that on this tutorial. All right, so going back to our discourse, you'll see that, like we've always said, the revenue is the income generated from the company's sales, goods or services. And what are the implications, which is very important. Let's speak to the number 10% we just generated, which is a positive figure. So a higher EBITDA profit margin indicates that the company is generating strong core profits related to its revenue, demonstrating operational efficiency and good control over core business activities. This is very important. So the control environment is key, especially in demonstrating and achieving a positive outcome of an EBITDA profit margin. Conversely, a negative EBITDA or a lower EBITDA suggests that operational inefficiencies or high costs are limiting the company's prospects or profitability. It may be an indication that the company is struggling to manage its operating expenses, or that revenue are not being maximized. So what are the cause and effect of this? A higher EBITDA margin shows strong revenue growth combined with effective cost control. So these two working hand in hand. You have strong revenue and also strong control. So positive and also a positive outlook has to do with controlling your costs. Operational efficiencies also reduce costs related to production or direct cost, administration, which has to do with indirect cost, and also the sales, which is the first important parameter generated for the company. So the absence of large non-cash items like depreciation and amortization, which I said earlier, depreciation is on tangible assets and amortization is on intangible assets, may also boost the EBITDA in asset-light businesses. This is very important. So on the other hand, a rise in operating costs culminate in lower EBITDA margin. Labor, materials, utilities, this indirect cost without corresponding and positive revenue growth can affect the EBITDA very, very negatively. Declining sales or revenue in a highly competitive or difficult market environment where there are serious competition, the need for significant spending on operating expenses like marketing, research and development, logistics is very, very pertinent. What are the effects? A high EBITDA margin shows that the company has strong cash flow from its core operations, making it easier to convert interest payment, taxes, and capital expenditures into profit. It can also increase investors' confidence as it suggests efficient operations and robust profitability. The EBITDA is a very important parameter or metric in speaking to the fact that management can really handle operations of the company very significantly, and the profitability speaks to their capacity as a competent management team. The company may have more flexibility for expansion, reinvestment of their proceeds, and also paying dividends to investors for funds injected into the company. Conversely or negatively, on the other hand, the lower EBITDA margin raises concern about operational inefficiencies, rising costs, and it can indicate reduced profitability, making it harder to cover fixed expenses like debt repayments and capital investments. This is bedeviling and can really be discouraging to management. It may also cause investors to question the company's ability to sustain long-term growth or profitability. So the sustainability question here is very, or it comes to bear when it has to do with the declining or negative EBITDA margin or a low EBITDA margin. Questions management's capacity or capability. This is a cause for concern as investors look at the company's books. So in conclusion, the EBITDA profit ratio is a useful tool for accessing the company's core operational performance without the impact of operational and non-cash items like depreciation and amortization. It is especially valuable for comparing companies within the same industry. It neutralizes effects of different financing structure or depreciation policies which are non-cash items. So a strong EBITDA margin is a sign of healthy cash flows actually. And good operational management, while declining margin may indicate inefficiencies in rising costs that needs to be addressed. So the EBITDA margin, like I said earlier, is a very important parameter. It shows a sign of good, healthy cash flow. So a sick company or a sickly run company shows inefficiencies in rising costs and culminates in a negative or a low EBITDA margin, which management needs to sit down and address squarely. This is very important. Okay, so having looked at that, we have spoken about the earnings before interest, taxes, and depreciation, which is an important parameter, and it helps us understand how the company runs its organic profit outside non-cash items and cash items. All right, let me know what you think about this important ratio, profitability ratio, in the comment section. Let me know what you observe. Any question you ask, I'll attend to them very swiftly. All right, don't forget to like, share, subscribe to the channel so you can be updated and notified of new content when we upload them. All right, I'll see you in the next class. Until then, bye for now.